Good morning, you're watching One News Now Markets. I'm Danny Laurel. Now, before we delve into the equity space, here are the top stories of the hour. As widely expected, the Bangko Sentral slowed its pace of monetary tightening and even signaled a pause at its next meeting. The Monetary Board raised interest rates by 25 basis points, bringing the benchmark rate to 6.25%. The overnight deposit rate now stands at 5.75%, while the rate for lending is now at 6.75%. And since May of 2022, the Bangko Sentral had raised rates by a total of 425 basis points, including 50 basis points each at its last two meetings. Bangko Sentral Governor Felipe Medalla clarified that the Monetary Board made the decision to hike by just 25 basis points even before the US Fed delivered a quarter-point rate hike.
With core inflation rising in February despite a modest decline in headline inflation.
Now, moving forward, Medalla said the decision of the Monetary Board will be driven by the inflation outlook. He says that if the inflation in March slows, then the 8.6% CPI in February, the board may no longer hike interest rates at its next meeting on May 18th. The BSP has slightly trimmed its inflation forecast for 2023 to 6% from 6.1% previously. Now, for the next meeting, the BSP also lowered its average inflation projection to 2.9% from 3.1% previously. On to the corporate front, PLDT is ruling out fraud in the issue concerning its budget overrun. PLDT Chairman Manny V. Pangilinan assures shareholders that the company's financial and operating conditions remain strong. Mobile journalist Michelle Gilang with the details.
PLDT says it found no evidence of fraud or bad faith in the 48 billion peso budget overrun case which came to light last year. It attributed the overrun to over-orders of 5G technology between 2019 to 2022. In a press conference Thursday afternoon, the telco giant also said the figure in question has been cut down to 33 billion pesos after negotiations with major vendors.
Our forensic review of the circumstances surrounding the CAPEX expenditure disclosed in the December 16, 2022 is substantially complete and identified no evidence of fraud, bad faith conduct on the part of any employee of the company, and no basis to restate the company's historical financial statements. So our 2022 audited financial statements is unqualified and no restatement.
PLDT Chair Manny Pangilinan also assured shareholders that the financial and operating conditions of PLDT remain strong and that they're not expecting a downgrade of their credit standing.
We're relieved that that is the case, and it's now incumbent upon management and the board to get back on the saddle and move forward, and demonstrate that despite this big hump on the road, the financial and operating conditions of the company remain strong.
But the budget overrun did hit PLDT's bottom line. Net income plunged by 60% to 10.49 billion pesos last year, even as total revenues climbed 6% to 205.25 billion pesos. That was driven by strong performances in both its home and enterprise segments. Also, revenues from the fiber business shot up 45% on year to 48.5 billion pesos, with the telco booking 514,000 new subscribers last year. For this year, it's looking to spend between 80 to 85 billion pesos in capex, and CEO Al Panlilio says they're expecting revenue growth in the mid-single digits. Mobile journalist Michelle Gilang, We Are One News.
The Makati Business Club and some other business groups are urging the Senate and House of Representatives to consider some points regarding the proposed constitutional convention, which they called as a, quote, potentially disruptive proposal at a time when the country is poised to regain economic momentum. In a joint statement, the group said political debate can derail recent reforms and President Bongbong Marcos's efforts to boost economic gains. The groups also said Congress has important work on economic and other legislation, such as the remaining tax reform packages. The groups also said the cost for Concon is high and the funds are better spent on pro-people programs. Circling back to the banking space, we have with us Tama Febrian, Director of Fitch Ratings Asia Pacific for banks. Good morning, Tama. Welcome back.
Morning. Nice to be here again, Danny.
All right, Tama, let's kick off with your quick assessment in terms of the strength of the banking industry offshore. How worried are you that this is a repeat of 2008, 2009, or how confident are you that the interventions so far have stemmed what could be a bigger contagion?
I guess when it comes to the fallout to the Philippine banking sector, I think so far it has been limited. We haven't really seen, an unusual kind of deposit runs that we've seen in like the likes that we've seen in SVB and the other markets. I think the Philippine banking sector, in terms of their depositor base, it's very markedly different than what we've seen in some of these failed U.S. banks, right? And I think in general, if you take a look at their capital ratio, these banks they do have a very healthy buffer to withstand some of the impairment risk, and we don't see the likes of the deposit runs, like a bank run scenario happening in the Philippines anytime soon. I think, in short, Danny.
What about the sentiment in terms of emerging market and financial space, the trust in the financial space in emerging markets? Has that changed?
We haven't really seen that. I think, in the fact that we recently came out with a state, a commentary in terms of APEC banks. I think generally, they are poised to be quite relatively resilient, and I think the markets are also factoring in the fact that whatever weaknesses that has transpired in some of these, banks, the likes of SPV or it's not something that we are very concerned of. I mean, you can also just take a look at the market share prices. I mean, if there were movements, but it's not exactly at the scale that we've seen in Europe and also in U.S. banks, and that actually speaks generally of the markets and confidence in the banking sector's health. Again, going back again to the fact that it's in terms of depositor base, really generally diversified and relatively quite stable.
Okay. Now, Tama, there have been talks, at least in the U.S., of wealth losses stemming from these issues. Can you give us more idea on how the situation in the banking space might impact the wealth of those people in those countries, and whether there's exposure in the Philippines or in Asia Pacific when it comes to wealth losses due to these banks?
Well, I mean, I think the direct impact is wealth losses probably from the losses on firstly from the deposit, the likelihood of the depositor loss, right? But I think that one is given the recent actions by the Fed, I think that's likely to be very, very limited in the case of what was happening in the U.S. Beyond that, and broader, I think. Wealth loss, if you're talking about in terms of equity values, I think it's likely that we're going to see some sort of rebound as markets continue to stabilize. And obviously it's something that continues to evolve, but I think that the central banks have done relatively quite a good job in trying to calm the markets, because we all know that I think. A banking sector crisis could have a very significant ramifications on the economy. I think we've seen that in 2008, right? Then there's that leads to a severe economic slowdown all over the world. So obviously, all the central banks don't want a repeat of that happening in the current times.
Okay, let's talk about the rate situation. The Fed raising as expected, but also signaling that they might start cutting rates, maybe twice this year even, and the BSP following suit, basically keeping in step. Give us an idea of, we've reached more than 6% already at this point here in the Philippines. Is this going to start eating on the loan growth this year?
I think if we're looking at rates that are at the current levels, I don't think that the loan growth. I mean, we do expect some sort of moderation in loan growth in general because we're coming off from rates that are as low as 2%, right in the pandemic area, and then to a certain extent, that significant rise of interest rate will dampen and make some investments. The economics probably don't make sense, right? So in a sense, that will taper some of the loan growth, but we don't really expect a major slowdown because I think in terms of the demand itself, I think it's still relatively quite strong. I think if we look at a lot of the banks' earnings, we are actually seeing that a lot of the corporates are still holding back on capex, and I think a lot of that is due to some sort of uncertainty. But now that it looks like it's looking a little bit more certain in terms of the rate trajectory, I think a lot of these will try to commit on these, and that will actually help to boost loan growth for the year. At the current moment, we are expecting loan growth to settle at around 7 to 9%, but there's probably an upside to this because if economic momentum actually pans up as better than expectation, I think there's likelihood that they could rise higher than this.
What's your outlook on consumption and also consumption loans and the impact on that, based on the fact that we're still above 8% inflation as of last print? Do people actually have the ability to pay their loans back, to get more loans with such high prices?
Yeah, I think in terms of the loans, I think in terms of the consumer loans, I mean, there's two big segments, right? So one is on the credit loan, personal loan, and then there's auto and residential. So with rate rises, I think the one that is likely going to be impacted the most is probably on the residential mortgage side first, because I guess the larger quantum will basically necessitate higher interest rate burden if people will actually take on the mortgages at a higher rates, right? So there will be some degree of tapering on that particular front. The credit card, I think in general, we do still expect growth to remain relatively robust. In last year, we see it going into the 26%, and largely that 26% growth, and that's on the back of the pent up demand. But I think a rate of around 15 to 20% is probably something that is we think that's probably probable. For the year, moderation, but I think it's still going to be quite a strong one.
Okay, and Tama, before we let you go, looking at the banks here that I have on my Bloomberg terminal, give us an idea of the strength of these banks with regard to the ratings and the outlook that you have on these banks.
1 sec. Sorry, I'm not able to see your.
Yeah, no problem. But maybe just an idea on the biggest banks, the level of capitalization.
The biggest banks are generally the ones that are more resilient. We have actually seen some of the financial performances of the bank. It's reflected in the financial performance of the banks. On the back of the rising interest rate, their margins have continued to expand much more so than some of the smaller peers, and that it reflects their entrenched strength, right? In general, I think if we're talking about the banking sector itself, we have a stable outlook on the sector. Basically, because we're seeing that some of these margin expansions will likely going to offset some of the potential risk in asset quality down the line. Now, if you're talking about ratings perspective, I think that's a different kind of story, because the ratings that we have on all the Philippine banks in our portfolio, they are driven by sovereign rating, and that's
Okay.
and we know that's on a negative outlook. So now that's sensitive to movements in the sovereign rating.
Okay, so a little bit disconnected there from the fundamentals that you've been pointing
Yeah.
out, and the resilience and isolation from the rest of the credit issues offshore. Thank you so much for those insights, Tama Fabrian, Director of Fitch Ratings over at Asia Pacific Banks.
Thank you.
And that's it for this hour. I'm Danny Laurel. Join us again at 11:15 a.m. We are One News, all sides, all the time.